Thank you, everyone, for joining us for another Learning Lunch hosted by FormatApproved.com. My name is Brian Johnson. I'm the Senior Director of Online Education with Format Approved, and I'll be your moderator for today's session. Today's Learning Lunch title is, If You Follow the Money, Where is the Healthcare Industry Headed? We're joined today by Michael Sarlitto of A Third View Medical. Michael has considerable expertise in healthcare acquisition and financial strategies, and he brings a unique perspective to the transformations underway in healthcare. We're honored to share his expertise with you today. This is a side of healthcare that I think a lot of providers and consultants often don't give a lot of thought to, and that's unfortunate because not only does it, obviously give you financial perspective on things, but it also gives you a different perspective on the larger picture going on in healthcare. So I think today will be a very interesting session. Let's take a glance at the questions for today's session. While I go over some housekeeping notes, you can just read over the questions real quick to give you the lay of the land. Remember that you can ask questions of our presenter at any time during today's session by typing them into the chat area. In the second half of our presentation, we'll address as many questions as time allows. If we do run out of time for questions, answers to those questions will be posted to our website and sent via email link later in the week. Also, remember that all registered attendees of today's session will receive an email with links to both the slides and the recorded version of this event, whether they're able to attend today or not. So for those of you who are wondering whether you'll get slides after the session, don't worry, we'll send those out as soon as they're ready. Before we begin, I want to thank you so much for joining us today, Michael. It's a real pleasure to have your expertise here.
Glad to be here, Brian. Thank you very much.
All right, well, let's dive right in then. What are the top 10 general industry trends you see in healthcare from an investor perspective?
Well, everybody can see the top 10 list in front of them. I would put the first two, aging population and chronic disease and regulatory changes, if I were to describe two macro issues. I kind of, from an investment standpoint, consider these to be gravity issues. These are things that are happening that we have little to no control over, and has the potential impact of dramatically influencing both risk and return associated with investment. First, the aging population and chronic disease. I guess it really shouldn't come as much of a surprise to folks what's happening with the population, and based on the quality of care, the increase in chronic disease in later in life. Now, just to throw out a few statistics, right now on the planet, population over 60 is roughly 10%. By 2050, that's estimated to be 20%. That's almost 2 billion people. Now, if we were to take a look at just the demographics or the statistics in the United States, in 1900, we had roughly 4% of the population was in this over 60 category. Today, it's 3 times that at 12.4%. By 2030, that's estimated to go to 17%. It begins to plateau by 2050 at 19%. What that relates to also in terms of the longevity is roughly turn of the century, 19th century, our life expectancy was about 46 years. Today it's 77.9, just under 78 years of age. By 2050, it's estimated to top 82 years of age. So with that increasing aging population, then comes the onset of chronic disease as a primary healthcare consumer of cost associated with maintaining that population. Right now, the top 3 causes of death: heart disease, 32%, cancer, 22%, stroke, 8%, all chronic disease related. In fact, 1 of 10 people today, that's roughly 25 million people, would report physical limitations due to chronic illness. Regulatory changes, number 2, PAPACA, Supreme Court upholding PAPACA.
PAPACA, yeah. Commonly known as Obamacare.
Exactly. And the Supreme Court upholding of that law then began to dramatically shift healthcare as we know it. The next four, 3, 4, 5, and 6, information transparency, consumers' knowledge and involvement, waning trust, I would tie all to a common root cause of there being much more information available to a consumer level. And with that information transparency, consumers are coming into their healthcare buying decisions much more knowledgeable and much more involved in that decision. And what it has initially spurred is a waning trust in the system. As we read more and more about statistics, for example, of the percent of patients that exit hospitals with more diseases than they go in with, that sort of thing. That kind of information being ubiquitous and available to all consumers is also having a dramatic effect on the buying decisions associated with that. And then coordination of care and quality. As we shift more to a consumer-oriented or retail healthcare environment, managing total from wellness to acute care to whatever it might be associated with an individual on the planet is something that is of interest. Item 7, care delivery. Now this is more to the delivery mechanisms, acute to lower cost distribution. I would describe that as distributed delivery, distributed provider networks, and we'll get into that a little bit later in the discussion. And of course, cost focus from price, pure and simple price to utilization and access. So as the provider networks see reimbursement rates diminishing, so on and so forth, they see a larger market share or share of the market, and that pie of potential consumers being the way that they're going to survive. 9 is the underlying, in my view, is the underlying root cause to a lot of the shift and the speed at which the shift is occurring, and that's technology advancement and adoption, principally in information technology, but also in a wide variety of equipment and procedures. And one of the things that dramatically affects investment, the investment framework, is the considerable spending outside the United States. So there's a lot of money that actually is leaving and heading globally to and being invested in healthcare outside the United States. And we'll get into a little bit of that a bit later in the implications relative to available cash and capital for investments domestically. But that would be my top 10 from macro to micro, if you will, top 10 general industry trends. And why it's important to understand the trends is, from an investment standpoint, there's two things that we're going to want to talk about. One is risk, and the other is return on investment. And we'll get into that part of the discussion a little bit later.
All right, sounds good. And you can already see here, I think, some opportunities and challenges around some of these issues. So how would you describe the current healthcare industry investment environment?
Well, we kind of segued from the last slide relative to what dominates investment decisions. Is primarily our risk return drivers. So if you think about cash as ubiquitous, it flows to where there's lowest risk and highest return, whether that be healthcare, maybe precision machining, could be injection molding, could be securities. U.S. healthcare spending is nearing 20% of GDP at this point. Now, you can't sit on $3 trillion in the middle of the room and not expect there to be investment interest. And there's all sorts of kinds of capital that are coming into the market as well, and we're going to talk about that a little bit later. The employer-driven downward cost pressure. Now, we've read a lot about how business is reacting to an increased regulatory environment. For example, 30 hours being the new 40. Full-time defined as 40 hours. You have a lot of employers now setting hourly totals at 29 hours so that they can avoid the higher costs associated with the healthcare benefit. Also, the number of employees in companies under 50 has a certain set of requirements, over 50, full compliance with Obamacare. So, and you have a whole plethora of waivers and all sorts of other intended and unintended consequences, I think, on business. A lot of the very large companies that have some political clout and lobby capabilities have secured waivers. But just by booking the additional projected costs associated with conservative treatment of the risk to their shareholders, it's something that is made public, and as a result dramatically impacts the implementation of the law. And actually, we're going to get to some of the other details associated with that right now. The implementation delays, there's a few that I think people read about on a regular basis, 1 or 2 or 3, the employer mandates and so forth. But all said, there's been over 30 implementation delays associated with the law. I've highlighted just a few: state exchanges, Medicaid expansion, and minimal essential health benefits as being 3 of the core. But what it ultimately drives, uncertainty associated with the investment and the return on investment and associated risk with those investments, creates a weakened investor confidence. And that's the 4th bullet on the risk return drivers. So what happens in this kind of environment is business and investment defaults to what they know. So, and what do they know? They know what businesses are in business now. They know which ones are profitable. They know which ones have appearingly have sustainable revenue streams, so on and so forth. So what happens is, in a fragmented environment, fragmented industry like healthcare is, you see a lot of vertical and horizontal integration and consolidation occurring in the industry. And we read about, you can read 3 or 4 or 5 headlines every day in the Wall Street Journal relative to what's going on in the market. So the whole idea is increase leverage. So you're increasing cost efficiencies by greater leverage in the supply chain, or lower risk associated with larger revenue or top line growth. And those are the 2 prime drivers to vertical horizontal integration occurring. And what a lot of companies will do is they'll dovetail in a acquisitive growth strategy along with maintaining an eye on the ball of organic growth. So they'll develop a hybrid growth strategy, which would be a combination of the 2. And that tends to help companies hedge not only where their cash is being placed, also the variables that they're in control of. So from a impact to the investment environment standpoint, those are some of the principal things that I've seen occurring. And I think if you were to plot the amount of M&A activity associated with healthcare in general, you'll see that it's light years where it was 20 years ago, and even compared to other markets and investment opportunities, it's absolutely in the top 1, 2, and 3, depending on what thread of investment you're looking at in healthcare.
So let's dive a little deeper then on the investment perspective. So based on the trends you're describing, are there any hot sectors in there that people should be aware of?
Well, I think I've got listed investment theses as the first bullet, and there's basically 4 core investment theses that investment capital is looking for anyway. The first is cost containment and outcomes. So the bottom line here is that you have a whole, when I think about the industry, you have consumers and any aggregators of, for lack of a better phrase, belly buttons, patients, and on one side, and you have payers or insurance companies on the other side. these two parts to the industry landscape, or stakeholders in the industry landscape, are all about cost and cost containment. When I think about then the other two sectors, the supply chain and those that everything from medical instrumentation to pharmacy, that sort of thing, and the provider networks, which would be clinics and doctor practices and hospitals, that sort of thing. They're all about revenue growth. They have got to have enough top-line growth to distribute their cost, their structural costs of doing business. So there's the top two, it's all about cost containment. And why it's important to understand the two is when investment is looking for a home, it develops this thesis, and all of the levers and the value drivers associated with return on investment pull in one direction. It's very important that the money is invested in such a way that it pulls in one direction. It's very difficult to invest in two diametrically opposed business models and generate any kind of reasonable rate of return. Second would be in payment reform. So here we've got a lot of regulatory controls, reimbursement rates, looking at the trending relative to reimbursement rates and playing that arbitrage between cost of delivery and what can be reimbursed. And what we're finding is that, particularly in healthcare, market-driven valuation of everything from procedures to intellectual property is now playing a very critical role in driving valuation associated with the investments there. New patient engagement and care delivery models. We talked a little bit about this. This is actually very, very important relative to one of the major trends that we're seeing that we'll talk about here in just a minute. But patients now, because of ubiquitous nature of information and data and knowledge, and the point of buying, the purchase point being a much more informed customer, if you will, not just patient, but customer, I liken it to lendingtree.com. You have now people engaged in one of the largest purchases typically in their life here on the planet, buying a new home. Essentially can be done less than 10 days. You can educate yourself on how to buy a home, all the terminology, who the players are. You can competitively bid, and you can select and actually walk through the process now in a matter of days. So that distributed purchase point in information is particularly important from an investment standpoint. And then hospital physician alignment. We continue to see a lot of vertical integration there. And the difference between vertical and horizontal, horizontal may be a physician practice buying a physician practice. Vertical is where you have up the supply chain a larger aggregator of service or supply buying those subcomponents, if you will. And that's what the hospital physician alignment is still a very hot sector. Second bullet, core bullet point there, healthcare light versus healthcare heavy. As this industry shifts more to a retail model or consumerism down to patients' buying decisions, what we're finding is the kind of capital that's coming into the industry is much more retail oriented. And the difference between healthcare light and healthcare heavy would be individuals who are invested in the industry that have long been in the industry. There's subject matter expertise. There's a depth and breadth associated with that industry knowledge that drives the investment opportunity. Whereas healthcare light, this is money that may not know healthcare very well, but knows retail solid. And with that kind of knowledge is able to capitalize and develop opportunities in healthcare that the incumbents and traditional investors in the industry haven't seen. We talked a bit about the practitioner aggregation and consolidation. Its primary thesis there is reimbursement protection. So you're balancing, portfolio of patient base that are 80% Medicare versus 50% Medicare, concierge care, that sort of thing. So you're looking at the quality of revenue there. The significant shift to consumerism and retail models, we're going to talk at length about that, but that is, if anybody walks away with one macro trend to really focus in on and do additional research on, it is this. It's the shift to consumerism and retail models on delivery of healthcare and that buying decision down to a patient level. And then, of course, we've had some investment and trends for a bit now in home health, accountable care, and IPA, and that continues on. Those tend to continue to be hot sectors from an investment standpoint.
And do you call that contrarian because it is contrary to the shift to consumerism, or?
Exactly. But what's happening is so with the total patient care and the underlying premise or principles of ACO, and now bringing the expertise directly into the home, as an example, it's item number one. What we're finding is that companies that have already been invested in senior living or hospice or those sorts of situations are expanding, and they're growing through acquisition. They're aggregating their reach nationally. So what you'll find is you may find a concentration of this kind of investment in the Southeast, and now as the population ages across the country and there's not just a primary co-location of elderly in certain areas, you see that the reach of these kinds of investments are going much more nationally. So their investment thesis would be all about geographical expansion and footprint, as opposed to just a specific area. One other thing I'd like to bring up at this point too, back to the light versus heavy. A couple of examples relative to the light would be the minute clinics, the worksite clinics, this whole shift to the channel and consumerism, where we're seeing it in employer space with absence management and wellness, and bringing those kinds of products directly to workforce engagement and HR management. And we didn't have that capability in the past. So this money that's coming in that is more retail oriented and distributed is actually a key enabler to some of the other trends that we're seeing happening. One last thing too. I would say that the leading edge of this shift to consumerism would be PBM, or the pharmacy benefits management industry. Think about CVS and Walgreens and where they come, and now where they're expanding to with clinics side by side, and actually their brand being brought into hospitals. So those are a couple of examples of the trends.
Well, I want to remind our audience that you can ask questions at any time. We'll save those for the end. We already have several questions, but do feel free to type those in now. So how can our audience better understand the investment lens viewing the healthcare industry?
Well, I'm gonna come back to the risk versus return, and there's a couple of specific measures that on the risk side and on the opportunity to return side. And keep in mind, the idea is the money has an opportunity to flow to a wide variety of different industries, a wide variety of different countries, planet-wide, so on and so forth. So the idea is, how do you evaluate a particular opportunity for investment in healthcare, in a specific company or a specific set of companies, in a specific portfolio, for example, or a specific thesis? And the first element is understanding risk, and the inverse, the probability of success. it's measured by a number of different measures, but sustainability of revenue is one of the core. The ability to maintain an upward slope, or at least maintain current growth associated with top line associated with a business. And what we tend to do from an investment standpoint, we look at sector-wide, and then we deep dive based on various factors, whether that's geographical, whether it's demographic, whether it's type of care being delivered, so on and so forth. So the sustainability of revenue is number one. Revenue concentration creates a risk. If, let's say, 75% of a business's revenue is associated with one or two clients, well, that creates a risk from an investment standpoint, because one decision to either cut back or eliminate a particular contract or client relationship could dramatically affect the potential return on investment associated with that. Quality of earnings speaks directly to the how much of that top line dollar translates to a dollar of profit at the end of the day. So understanding where the margin is coming from, where the costs are, and optimizing the whole cost associated with running that particular business. So to the extent that you may have, over the course of, let's say, a typical look-back period in financial valuation is 3 years, well, what investors are looking for are any one-time events or windfall, either on the revenue side or on the profitability side, that dramatically improve to the good a particular metric, financial metric. They're looking to discount those kinds of perturbations so that they can get a better idea of what may be the future. And I will say that also privately held firms, particularly smaller practices, that there's a lot of commingling associated with the costs, their personal costs and their ownership interests associated with a company. So, you know, the advice for smaller practices or aggregated practices that are positioning for potentially a sale or an exit or some kind of transaction down the road would be to understand what the value is without the specific ownership costs built into the financial models. And then finally, cash flow and cash flow management. How efficient is the operation in collections, in managing the risk associated with collections, AR/AP, age trial? Those are the kinds of things that are. In fact, there's companies set up to help a lot of other companies in improving cash flow management, because it's such an important aspect. That also impacts the interest rates associated with any kind of line of credit or working capital that the business may be paying out. In the second half of the equation, of course, is the return on investment. And again, I'll reiterate, the opportunity triage is something that investors and portfolio managers spend a lot of time doing, because their money can go a lot of different places. And in some cases, as it has been in the more recent past with this fairly extended, protracted recessionary environment, there's a lot of capital sitting on the side. There's a lot of money sitting on the side because the risks are high or the returns may not be there. They're better off in a lower return right now. So they're looking at growth and profitability associated with different opportunities. How they figure all this out is by conducting due diligence. And there's basically 4 varieties of due diligence: financial, operational, legal, and commercial. Probably most important to the audience relative to our listeners, relative to the future opportunities, would be the commercial due diligence. That's where we take a look at where the industry is going, where that particular sector or that thread of investment would be going, and tie back all the other metrics that we've already talked about, sustainability of revenue into the future and that sort of thing. But anyway, investors spend a lot of time on due diligence, getting an understanding of not only on a sector basis, but also on a specific target or investment opportunity basis, exactly what they think the risks and the potential return is. And that's how they do it with due diligence.
So what current issues and those on the horizon pose risks to maintaining investment market value?
Well, in healthcare, I would say that I would put at the top of the list compliance, particularly those that have been legislatively driven. We have in investment circles, whether say, let me give you an example. In 2005, the Energy Act, the U.S. Domestic Energy Act, that spurred all sorts of investment in wholesale wheeling and trading of electricity nationwide, and infrastructure, transmission, distribution, a lot of generation, alternative generation, so on and so forth. So there was a precipitating event that caused a reaction to the markets. In this case, with healthcare, PACA or Obamacare was one of those neutron bombs, if you will. And what I've listed there are probably the more visible and prolific areas. The physician quality reporting systems. Of course, we all started with the EHR compliance requirements, meaningful use, so on and so forth. So there's a laundry list associated with the various compliance associated issues. Now, some of these have been completed. Some of them have been delayed. Now, think about that from an investment standpoint. You have a whole battery of requirements that you know you're going to have to comply with, but you don't necessarily know the timing. You don't know how many dollars it will take in investing in particular solutions to meet the current interpretation of those regulatory requirements. So in a lot of respects, it can be a moving target. Now, so that's why it's very, very important in evaluating this particular industry that the companies that the stakeholders in the industry saddle up to relative to their compliance is very, very important. And so, as the industry walks through these compliance issues, and I guess probably the most prolific has been HIPAA compliance. HIPAA can actually create an Armageddon event. I would refer to it as an Armageddon event relative to an investment, where you can have one breach can create such a negative event associated with a particular business that not only the fines and the reputational problems and so on and so forth, there's a high risk and a dramatic impact to the potential return on investment. It's probably similar, an analogy may be brand and marketing around a personality. It's often said that that comes with a high return, but also a very high risk. If there's something found out about that particular high-profile spokesperson, you can potentially tank your entire brand overnight associated with that. Well, some of these compliance issues, I think fall into that category. The second category, I guess, relative to risk would be the currency, relevancy, and the quality of not only what it is that's being delivered, but how tuned in the particular investment that you're contemplating is. So if it's tail wagging the dog relative to intellectual property, or if it's it's a business that continuously lags relative to the metrics associated with the industry. One example I gave there is the avoidable readmissions, which is getting a lot of attention these days. And the reason why it's getting a lot of attention now is the thresholds for avoidable readmissions is tied directly into reimbursement now. And and now, think about it this way too, you have consumers armed with information relative to readmission rates. It's no different than college rankings based on placement and starting salaries. So now you're getting access to information, performance-related information in the provider network and the hospital system, so on and so forth, that we didn't have access to before. In general, also, depending on the revenue profile, declining reimbursements has an overall negative effect relative to return on investment. To the extent, for example, that let's say 85% Medicare-related practice is able in a 3 to 5 year time period to shift to 50% concierge medicine at a 200 or 300% multiple relative to reimbursement or return. That's a plan that, depending on the plan, is quite investable. And then the last item is the rate of industry consolidation. It gets, in certain sectors, can be dramatically advanced and sped up with data. A new revelation relative to how data correlates in outcomes can have a sometimes, in some cases, a devastating effect on the players in a particular area. And in other cases, those that are ahead of the curve are actually very well positioned. And investors are looking for those companies that are very well positioned like that. By the way, we talked very briefly about the meaningful use, but the Massachusetts Medical Society right now is fighting with the state legislature to pass a bill to require meaningful use of health IT for doctors to maintain licensing beginning in 2015. So it's a very real, these compliance issues and investment and quality impacts to that are very real issues, and these are things that investors have to take into account.
Yeah, that's a great example. We've been following that story, and of course, most providers absolutely hate the idea. It's not surprising that the medical association out there is fighting it, but I do think people should expect wider adoption of those sorts of requirements going forward. And, like you mentioned on here, the value-based modifier program, I think my suspicion is most of the audience probably has no idea what that is. I think most providers don't know that it is coming online. And I think it's really going to surprise people when their reimbursements start getting hit because they're not participating in it. But it's just really setting the stage for adopting that even more widely. There's talk about MIPS and that sort of thing. So I think it's going to be surprising for a lot of people that these initiatives aren't the end of it. They're really the beginning of this sort of change.
Yeah. And it's interesting you bring that up, too. When I think about provider, let's just go to a small practice and their compliance. I know personally know an ophthalmologist who was just out of the blue running some numbers relative to his practice. He's 60 or 56, 58 years old. What he came up with was the margin that he generates or generated on a certain type of procedure 17 years ago, 20 years ago, requires 17 of those procedures today. Mm-hmm. In other words, he's had a 17x decline in his profitability by procedure. So when you think about that, put that in the context of how much money was being made, in the practice of yesteryear and how valuable it was, to now think about what kind of volume he needs to do now to generate close to the income or anywhere near the income that he was generating some time back. Even adjusted for inflation, it's a fairly phenomenal amount. So you're absolutely right. And one of the things that I know you're struggling with was the whole Medicare reimbursement at risk with the electronic health records compliance issue.
Right.
So yeah, there's things that, and if you think about it from an investment standpoint, this healthcare light, they don't have a clue. Their money is coming in, but they don't have a clue. The healthcare heavy, the people who've been in it for a while, they understand the risks associated with this, and that's why they tend to have a bit more solid grounding relative to quantifying, qualifying risk associated with the investment.
So how can providers, investors, and payers assess options for securing a more solid economic future? I mean, we're sort of covering some of the uncertainty out there. What's good strategies?
Yeah, well, okay, so let's start providers first. According to the Association of American Medical Colleges, the U.S. is going to have a shortage of roughly, a little over 91,000 physicians by 2020. That's not that far away. So when you think about relative to compensation, where the risk is associated with the ability to even deliver a growing demand, think about it. If I was an investor and I knew that there was going to be a shortage within the next 5 years of any kind of commodity, and I had some relative degree of certainty that that was going to occur, safe bets are in positioning and creating options and scenarios from an investment standpoint to fill that gap. So when I think about, let's start at the smaller level. I think smaller practices, 2-3 physician or smaller hospital, that sort of thing, viewing the business as an asset versus a job or a lifestyle, I think it's the first fundamental change that I think individual business owners, and it's not just healthcare, it's every business, that business owners need to grapple with. Once you get the idea that what it is that you're building is marketable, that revenue stream is marketable, that book of business is marketable, the ability to turn $1 of revenue into 50 cents of profit is marketable, the sustainability of that, the ability to create profit is marketable. Once you get that understanding, all the other bullet points make sense, right? Having goals relative to time frames that are valuation centered. We talked earlier about the due diligence that investors go through, the financial, operational, commercial due diligence along with legal. What they're doing is they're trying to quantify risk. And think about it, if a practice is primarily centered on an individual's performance instead of process, for example, or memory instead of captured records, so on and so forth, to the degree that a business, and I don't care how large or small it is, can institutionalize its business and work processes, the more investable it is. Because what you're trying to do is create an environment that survives the current ownership. And the more that you can demonstrate that to the investment community, the more investable you are. Contemplating exit strategies, just understanding. Now once you've modeled your business as an asset that has a potential value when you're done with it or when you decide that you'd like to exit, just understanding what your exit strategy is going to be, whether that's merging with another company, whether it's offering it to employees. But there's a lot of different structures and frameworks, and I think in this is where my particular passion in the industry starts to begin to come out. What I do is merger and acquisition associated with a wide variety of industries, and with healthcare, a third view medical, and looking at all these different sectors and how they play into where the healthcare industry is moving into the future can be very complex. And walking through that and really understanding that takes a lot of effort. So the more tuned in that the business owners and individuals are relative to the markets that are not only investing in them, but investing in all of the compliance, the requirements in the industry in general, the more tuned in they are, the more reactive they're going to be able to be to perturbations in that. So understanding that transaction landscape. Also understanding, we talked about the difference between some of the healthcare light and healthcare heavy. The financial versus strategic investment. To the extent that a business prepares itself and opens itself up to potential transaction opportunities with those who see the business and value the business differently than just on a financial basis, is the holy grail. So, for example, let's say you own a podiatry practice down in Florida, and there's a group up in Massachusetts that has been wanting to expand in Florida for quite some time. You use the same kind of patient care and processes and some business processes. So you're a unique asset to be chasing down in getting a foothold in Florida, let's say. Well, you're going to be worth a lot more to that particular buyer as distinct from marketing the business, just out in the open. So understanding that financial versus strategic investment on the money side is very important. And we could spend a whole day on valuation approaches, but just in summary on the valuation approaches, just understand what you're trying to do in terms of valuing your business as an asset. You're going to come up with a range of a low up to a high, and depending on how the business is doing and your role in the business and where the risks are, that'll define what the valuation settles at from a market standpoint. We talked a little bit earlier about the growth and understanding organic versus acquisitive. A really good approach, I believe, is that you're prepared to launch an acquisitive growth strategy. You're capable. You have access to assets to be able to do that. But at the same time, you understand the business as an asset demands that you keep your eye on the ball relative to its profitability and its ability to stay solvent. Deliberate positioning relative to buyer, seller, collaboration partner. A lot of ownership relative to existing business and future business or business combinations is something to think about. There's all sorts of different ways outside of a formal merger or formal acquisition to bolt together a couple of businesses and do the 1 + 1 = 3 instead of what you'd get on your own. And so then being prepared. So the bottom line is, if you think about thinking in the industry, think about a pyramid. You have strategic issues at the apex of the pyramid, the middle layer is operational, and down at the baseline is tactical. And most of us are day in, day out involved in tactical running of our businesses and doing what you need to do on a day in, day out basis. Every now and again, you got to come up to the top of the pyramid and take a look at where the industry's going, what it's doing, and why it's going there. To the extent that you can do that with some kind of frequency, some kind of regularity, and adjust your business as you go, makes it much, much more marketable, much, much more investable. And this doesn't have to be, an investor coming in. This is the same story that you would want to be telling in expanding your line of credit or access to working capital to grow your business. You want to be able to have this kind of outlook, this growth outlook, and be able to display it to whoever it is that you're asking for something, whether it's money or time or whatever it might be.
So let's talk about how stakeholders can improve operationally to get increased valuation and investment interest.
Well, I know we're getting a little bit tight on time, so let me just focus in on a couple that tie right back to I think this consumerism and retail model. The fourth one down, the business work process versus people dependencies. That when we talked earlier about the healthcare light versus healthcare heavy and the distributed model associated with care delivery and the purchase point, the decision making associated with the analogy of LendingTree.com at a patient level, the investment capital that is coming into the market far outweighs any other investment capital coming in this retail and shift to consumerism. And what it depends on is it's highly dependent on that business having operational recipe or playbook for how they grow, how they retain customers, the whole customer service aspect of healthcare. And it's non-existent right now. Well, for large, all intents and purposes. It has not been a consumer-oriented business or industry. And you're seeing a dramatic shift now in investment capital. And it's not because they see huge opportunities yet. It's that capital is actually making the market. It's making the opportunities. So if you have billions of dollars coming in, pushing retail, pushing distributed, pushing tech-enabled, pushing social media-generated consumer ranking of doctors, as an example, you're seeing emergence of a whole shift in the entire industry. So if nothing else, I would say that understanding how to tech-enable all the business work processes, number one. Number two, thinking about whoever it is that is consuming what it is that you're providing. Begin to model them as a consumer with choice. Begin to model them as a customer that needs to be retained. Begin to model them as a retail or operation would ordinarily establish those value drivers and that sort of thing, because it will in the future it will directly translate from an investment standpoint to all the things we just talked about: the sustainability of revenue, the ability to generate quality earnings, so on and so forth. So, in the last bullet, then, last two bullets actually, the tech enable. I see the tech enabling and compliance issue is absolutely baseline. If you're not settled up with a rock solid tech and compliance platform, you're going to have problems in the future. It can't be cobbled together. The individuals will not survive, and it's going to be all about being able to generate that leverage and scale. And what's not investable is risk associated with the compliance side of things. So as it relates to the training, the technology, the platforms, that sort of thing, saddling up early and getting into it deep to make sure that you've got compliance nailed and you've done everything that you can to nail it, even with shifting requirements, is going to be critical from an investment standpoint.
Yeah, I would just amplify that point, because we talk to people in the industry all the time about the fact that hospitals are sort of gobbling up lots of practices, as you've been discussing, and often discovering that those practices, their compliance picture is just an absolute mess. And then trying to sort out that mess takes a lot of time, a lot of money, a lot of effort. And you have to think that there's going to be a growing awareness among investors and those who are acquiring these practices that this is the major, or one of the major risk factors in terms of acquiring a business like this.
Well, and being an investor myself, I can tell you that to the extent it ends up being an area that they don't understand, they're going to buy they're going to invest in the ability to quantify and qualify that risk associated with it. So,
right, great point.
It's one way to absolutely hedge the risk is by buying that subject matter expertise and the competency and capability and weaving that into the decision making for the portfolio.
So how can stakeholders then prepare financially to create viable investment options? You've sort of been touching on it the whole time, but let's just go through some of these quickly.
Sure. Not relying on single sources for information, I think, for decision making is critical. So what we call in due diligence space is triangulating in on truth. So if you think you have a fact, if you can get two other independent corroborating points that yield that same kind of outcome, then you've probably arrived at truth. Outdated information, but it's a simple thing, but a lot of people don't do it, and they don't take the time to do it. But updating outdated information, making sure that financial statement inconsistencies are all cleared up. Creative is a good example of a company that went down a path of having some issues, and now they had spent the last 2 years, 3 years restating earnings, and I think they just announced that they were delisted just in the last couple, 2-3 days. High intangibles or goodwill value understanding. We talked a bit about the transaction terms, merger, acquisition, potential collaboration efforts, joint ventures, that sort of thing. Just getting an understanding of how companies can work together and understanding synergies. Tax is a big thing, and with the healthcare law, understanding both personally and from an asset standpoint with the business where the tax liability ultimately lies, and then you know, a lot of situations. We touched on it. I could probably do a whole talk on the valuation techniques and that sort of thing, but running out and doing a valuation for no you know, apparent reason doesn't make a whole lot of sense. Valuation is influenced by intended use of the number, and that's why typically when we do it, we come up with a range.
Yeah, and you know, the devil's in the details here. The valuation has to be a lot of the, given the uncertainties and all the complications of what you're talking about, that's got to be a process where it's just a lot of different moving parts.
Yeah.
When you say inappropriate consideration of synergies, I know we're running short of time, but could you just say something briefly about what you've got in mind there?
Well, if you're making assumptions, for example, that two parts of the business, once combined, are going to create opportunities that currently are not, you know, not on anybody's radar, for example, and actually try to assign a number to that. That kind of math, if you will, doesn't register with return on investment calculation, as an example. So another example may be you think that current ownership of a company that you're potentially acquiring, because it's more homegrown, would be compatible with a more corporate environment, that there would be a synergy. They could act as your entrepreneurial arm, for example, when at the end of the day you get through a 100-day operating plan post-merger only to find out that not only has that individual fallen away, but their entire leadership team has fallen away. Well, that's a synergy that you may have valued in setting a purchase price for that company or target or you know, asset, and it turns out that it was all fluff. So just really getting down to nuts and bolts relative to what you think is going to be accretive, what you think is going to be synergistic, and generating to some extent during due diligence some tangible evidence that that's what it's going to yield.
So there's so much to do here. There's so many different aspects to it. How can a business avoid feeling like it's boiling the ocean?
Yeah, well, I think we all get sometimes when we get exposed to a lot. It's like drinking from a fire hose. You get you know, you get inundated with so much, and it just spurs all sorts of thoughts. I think recognizing paralysis through analysis is probably the number one takeaway. And I added there precision through revision. I am an engineer by degree, and so the analytical side of me relative to due diligence is what clients pay for. They want a fairly you know, focused eye on understanding, quantifying, qualifying risk associated with their investment opportunities. But sometimes what you have to invest time and energy-wise to qualify or quantify that last fraction of a % of risk isn't worth it. So sometimes you just need to, you know, make the investment or make the decision with what you've got. And I touched on this a little bit earlier, the strategic, operational, tactical. That's a kind of a good way of looking at all of the operations too as well. There are strategic, the alignment of strategic, operational, and tactical goals. I think then evidence of that brings companies and I think investable companies anyway a lot further down the road. We talked about opportunity triage, and not all money is created, of course, equal, but there's always other opportunities for money to be placed. You do see a lot of, I think, the opportunity in information technology and the combination of a wide variety of different areas of this industry, this cottage industry, to more of a market-based, retail and consumer-oriented type of an environment, I think, is huge. So that, you know, saddling up on the IT side of things, the technology side, and where the data is going, data ultimately is going to be the key enabler and power in this particular industry. and how that then is turned back out on meeting or exceeding compliance-related issues also.
So are there other situations and perspectives that stakeholders need to keep in mind here?
Well, just a couple. So if you think your business is fully optimized and everything else, okay, position your company as an organic growth engine for a future owner. You know, understand why it makes sense for a particular investor or a potential future owner to want to even talk with you, okay? If your reason is, hey, I want to bring our operation to the next level, I know it's going to take resources, and you look like the right partner, that's a salient argument for an investor. If you think operationally you're confident everything's fine, and you're large enough, position your company position your business as a platform for investment. In other words, if you're large enough and you have the resources to be positioned as a platform for growth, you do the acquiring, you do the investment, and solicit the investment in your company as the platform for growth through acquisition. Shopping the business out, generally, unless you're in a turnaround situation or you're highly priced premium, in other words, you're able to command a price premium in the open market. That's the only time I would ever recommend shopping the operation out. And again, following the money, understanding private equity in particular is a key investor in healthcare right now, and they have got a really strong foothold in a wide variety of the different sectors within the industry. So doing your homework and understanding who's investing where and why, and then positioning your asset or your company, your business to be attractive to that. And this rifle versus shotgun, we talked earlier about strategic investment, strategic capital versus just a financial play. The strategic will generate anywhere from 1.5 to 3.5 improvement in multiple associated with the asset, the valuation, and the purchase price of that particular business. And at the end of the day, what you're trying to do is position for maximum value, whether that's on exit or in growth until you decide that it's time for a change.
Well, I'm afraid we ran out of time. There's obviously a lot of different things we could go. I feel like we could do this for 3 hours and still just scratch the surface. But for people who are interested in learning more, go to www.thirdviewmedical.com, or you can send emails to, certainly send them to ForMed at ForMed Approved. We'll be happy to pass those on. We'll answer all of your questions as well. Michael, is there a way they can contact you if they'd like to discuss some of what you've touched on here more?
Certainly. M. Sarlitto at thirdviewmedical.com. Feel free to just jot a quick email to me, and I'd be happy to answer any questions. I apologize for going long because I'd much rather get to Q&A too as well. Maybe, Brian, we need to do these in 2 sets. One is the presentation, the follow-up is the Q&A.
Maybe so. Maybe so. Well, there's a lot of interesting information here, and so I'd just like to remind the audience that we're going to send out the recording and the slides so you can review those at your leisure, and then do contact a Third View with any questions you may have. Thank you, Michael, for joining us. Great session.
Okay. Thanks for having me.
If you're interested in the training that ForMed Approved offers, you can go to formedtraining.com. We have training in meaningful use, HIPAA, ICD-10, or EHR, so if you need to catch up on some of those compliance or some of the changes going on in the industry, that's a great place to get information. You can visit formedapproved.com to learn more about our upcoming learning lunches. We have these every week. The Learning Lunch button will take you to our upcoming webinars where you can learn more about each event and register. Our next Learning Lunch will air March 25th and has the title, What to Do About Mandatory Policies and Procedures. Keep an eye on your email box on our homepage for other upcoming topics, and thank you again for joining us today.